Awesome. Well, welcome everybody. Appreciate you jumping on tonight with Money Monday, IBC, and the Fiat magic trick. We just thought we'd share some really cool things tonight. We'd kind of dip in and kind of show some comparisons, all things IBC, because that's what we love is the infinite banking concept. So Dave and I thought we'd just share some really cool charts and, see where the discussion goes. You guys feel free to jump on tonight if you have a question, or you can type them in the chat box. Is that cool? So Dave, welcome. It's good to see you again. And where would you like to go first? What would you like to start with?
Well, let's, what I did is I've been playing around a little bit. As you guys don't know or you do know, besides infinite banking, I am kind of a student of the markets. Which I know you shouldn't depend on it for your retirement. I like watching charts. It's the nerdy side of me. So
he's really good at it too.
Thinking today about interest rates, like we always do, and no, not really. I can think it in my head and I can't explain it that well. But I got discussing this because we are doing a what if scenario. And I'm going to start out with the what if scenario. I'm going to show it to you guys on a screen share and a little bit of input. So we're going to assume, this is for assumption reasons for as we start tonight, that you've got $40,000 of cash value in your infinite banking policy. In becoming your own banker, Nelson Nash loved to always state that, you take out a loan to finance your life. And he loved to use the car loan example as the example, mainly because everybody at some point in their life had a car loan. So it's the lowest common denominator. And anyway, so what we're going to discuss was, if you had $40,000 cash value that you could borrow against in your infinite banking policy, and you wanted to go buy a $40,000 car, there's a couple different ways you can do this. First off is you can borrow the money and finance your own car. And I said, so let's go really crazy here, and or you can go get a bank loan and not touch your money and let your money grow, compounding in your infinite banking policy outside of taking a loan. And the reason I started talking about this is let's say you got two things you want. You want to buy a car, but the market is at 10-year lows and there's some good stocks you want to buy, some good high dividend paying stocks that you want to buy. And you only got one place for this money. I said, but you've got good credit. You can go to the bank, get a loan for the car. Okay. We'll look at that. So we've got one pot of money, three things we want to do. We want to let it compound and leave it alone in our policy. We want to borrow against it to buy a car, or we want to borrow against it maybe to buy some stocks on sale that have a good dividend yield and have potential for appreciation. Well, let's say we make the decision, I want to go buy these stocks, but I still need a new car. I'm going to go to the bank. I go to my local banker at Wells Fargo, and it's all creepy when you walk in and, they always want to say, hey, how can I help you today? And all that stuff they do at Wells Fargo that creeps you out. And then they say, okay, we can give you a loan at 5.5%. And you're like, great. And my internal rate of return right now is about 4%. When I figure it all out at the end of the year, I'm getting about 4% on my infinite banking policy. So first off, you're saying, well, if I take out a 5.5% loan and I'm only earning 4%, is that a good deal? So I'm going to show you guys, I'm going to screen share for just a second. We're going to take a look at this. So I'm going to go to, because Paul, we were talking about this. This is a loan amortization chart I did on a 5-year, 5.5% car loan.
And
what I want
hey,
you guys
Dave, can you hear me?
Is up on the top here where you see everybody see loan amortization schedule up the top? I can hear you. Yes.
Yeah.
Did you lose me?
No, it's just, I think there's a delay tonight, but we're overcoming it nicely. But I guess
am I herking and jerking?
Yeah, well, at least on my screen, maybe not everybody else's. But that's okay. It's
everybody hear me okay?
I'm really getting excited about.
Give a thumbs up.
I'm excited about seeing this. What are the options in a situation like
Anyway,
this?
I'll talk.
What are the options when
All right.
you
The options are we can take out a loan
purchase,
from the bank.
or pay cash, right?
Yes.
Okay.
You pay cash. Can
Yeah.
you hear me okay, Paul?
Yeah. I think there's just this
Yeah.
huge delay tonight. Anyway, I just wanted to kind of throw out some of the alternatives for the folks who are watching, because everybody's thinking different things. I mean, they push leasing and they push just paying cash, or we're trying to show how incorporating an IBC policy is just like superior to everything else. So yeah, I'm just excited to see you display that right here in front of our eyes.
Okay. And can you hear, is my sound coming back yet? Can you hear me?
Yep. Yep.
Everybody's nodding. Yes, maybe. Okay. Yeah, I got a really bad connection tonight. I'm really sorry about this, you guys. Anyway, okay, let's go back to the share. I'm going to. So as you can see here, I've got a loan amortization table, and it's a 5-year loan at 5.5% interest for $40,000. Your monthly payments would be $764.05. And at the end of 60 months, 5 years, the total interest you would have paid is $5,062.32. Everybody see that okay?
No.
What's that?
Can't see your screen. The share.
All right. Next. Paul, give me a verbal you can hear. Okay, there we go. All right. Here's the share. So then here's our $40,000 policy that's earning 4% interest, okay? Oh, not 400%, 4%. The crazy thing is you're earning 1.5% less interest over the same amount of time. But if you take a look, your total interest you've earned over that 5 years is $48,839.86. Okay, so even though you've had a loan that has higher interest rate because of the compounding factor, and this is just an exercise in compounding, that you've actually made more money over this time. You're approximately $3,800 ahead from where you would have been even with taking out the bank loan. Okay. Unshare. So, any questions in that so far? The fact is that you don't have to have the higher interest rate to make money at this. You're looking at an interest rate that's 1.5% less than your bank rate. You take out the bank loan, you've still got the money ready to do something else. The and asset, as they call it. So let's take a real quick look. Stocks are low, so we're going to share. I'm going to show you guys just one idea I came up with, which is right here. This is a company called, can you guys see this okay? Here, I got to get the share in here. There we go, share. Can you see that okay? What are you looking at, Paul?
A blank. There we go. We've got the
Iron Mountain Incorporated.
Iron Mountain. Yep.
All right. Iron Mountain is about as boring as you can get. They store documents and they grind up stuff. You see their trucks around. They come by into what they'll do is it's corporate data storage, and sometimes it's where they basically store it physically in a lockdown, temperature controlled facility, or they will digitize it and store it. store it. And sometimes, and they actually have some data centers they run too. Iron Mountain forever was about between $28 and $32 a share. It's as boring as it gets. They took a big hit back in March when everything else went down, and so did they. But the key, what I want to show you here is they have a yield, they have a dividend, because it's a boring dividend paying stock of 10.07%. And what you'll find is most of the real estate investment trusts right now are yielding between 8 and 12%, depending on their quality. And there's some real estate investment trusts that are pretty high quality that aren't exposed to retail, it's industrial or it's warehousing. And it's stuff that even with a downturn in the economy, they mostly have net leases. And so they basically, the stock stays the same, and they pay out anywhere from 60 to 70% of the revenues in dividends every year. So just to take this as an example, we've got a 10.07% interest rate on this. So I'm going to go back in to our savings account here, and I'm going to, let's go new share. I want to go back to this one, share it. Here's our $40,000 in our infinite banking policy that's earning 4% right now. Okay, let's take this out.
We don't see that, Dave.
Oh, you don't?
No.
All right, let's try this again. I can't go to switch share. I have to stop it and restart it every time, you guys. That's okay. That's what's happening. Just keep telling me this, because I can't see can you guys see this yet?
Yep.
Are you seeing it now? Okay. Yep. Says savings interest calculator here up at the top.
Yep.
All right. So you've got your infinite banking policy, $40,000. So you take it out and you borrow the money to buy Iron Mountain stock. Okay. Iron Mountain now has if you look down here, we were going to earn $8,839.86 over the 5 years of the car loan, while the car loan's sitting out there getting your new car. But now we've got a 10% yield, which, okay, we'll take it out in a loan. Our loan rate is,
okay. You want to just slow down and repeat that and explain what that 10% is? Just
okay.
Again,
Thanks,
just slowly. Yeah.
Yeah. Okay. So stocks are, you can make money in stocks a variety of ways. One of the ways is the stock actually appreciates, which is what we all want it to do, go up, like Amazon and Apple and all the rest. And when they're in our traditional retirement accounts or something like that. And that's how we make money, is appreciation. The other way to make money in stocks is through dividends. And what happens is a stock dividend is not like an insurance dividend in the sense that stock dividends are taxable. But if a company, it throws off income, they make money, they pay all their bills, and they take care of all their capital expenditures, and they still have money left over, they will declare a dividend. Most dividend paying stocks average in the 2 to 4% range. When you're talking about they call widows and orphan stocks, Exxon, AT&T, the stuff that has that's declared dividends for a long time. It's in a stock portfolio, and this has nothing to do with insurance, of how much money the company throws off to the shareholders. And a dividend is a certain amount per share. Okay. The trick with real estate investment trusts is they run kind of like mutual insurance companies in a way, whereas they own property, they collect rents, and they run their companies as property managers. At the end of the year, if they have a profit and there's excess cash, it's thrown off as a dividend to the shareholders. And that's when we look at what the dividend yield is on a stock. And it changes as the stock price goes up and down. But it's right now, like Iron Mountain is yielding 10.7%. So if you buy the stock at $24 a share, what it's trading for right now, the end of the year, they're going to give you a $2.40 dividend for that. Okay. So I just got to notice as I'm sitting here on my Zoom meeting that my internet connection is unstable. That's why you can't hear me, Paul. Are you still there?
Yep, I gotcha.
Okay. All right, cool. Anyway, did all that come through? What I just got done saying?
Yep. Yes.
Okay. Anyway, so where I step back is we've got our $40,000 sitting in our infinite banking account, and it's just sitting there, quietly earning its compounded 4%. It will continue to do that. So from today to 5 years out, we're going to earn $8,839.86 on our dividend in our policy. But what we can also do is we can borrow from this policy. It will continue to earn this dividend rate throughout the next 5 years, but we're going to take a loan out. And the loan comes from the general pool of the insurance company. They're going to send you a check for $40,000, and they're going to say on the anniversary of this loan, you're going to owe us. And Paul, you'll have to tell me what's Lafayette's rate right now? Is it 5% or 5.5?
5.
5. Okay. At the end, on the anniversary of your loan, we're going to figure out simple interest. You're going to owe us 5%. So here's how you make some money. You basically take your $40,000, you borrow it, you buy a yielding stock, and I'm not suggesting anyone do this. I'm just using this as an example. At $24 a share, you buy $40,000 worth of it. It yields for a 10% dividend. So that will be an additional $4,000 a year over the next 5 years. So I'm going to go turn here. I'm showing you our screen with the 4%. Now I'm going to take this and I'm going to put it up to 10.07%, which is what Iron Mountain is yielding today. Our value after 5 years is $66,041.19. So we've earned $26,000 on the dividends on this note. Okay. So on this note, I'm going to show you this here. We're going to pay down the note as we go, and you only have to pay down the interest on an annual basis. There's not, we recommend using a monthly payment schedule, but if you don't want to do this, we can do this. Loan period in years, number of payments per year. I'm going to show you guys this. I'm just adjusting this as we go here. I'm going to share here. Loan amortization. Wait for it to click. Can you guys see the loan amortization table?
No.
Yep. Okay.
Yes.
Not yet. Yes. Did it take a minute?
There it is. There.
Okay. There it is. All right. So I showed you what we earned in interest in dividend payments on that stock. Okay. So now here's our loan. Here's our loan with the insurance company. It's a $40,000 loan at 5%. Okay. We only owe the interest once a year on the anniversary loan at simple interest. So over the same period, while we earned $8,000 interest on our compounding policy, we took the money out and we made another $26,041.19 on the dividend yield on the stock. And then we paid in a total of $6,142 in interest on this loan over the 6 years, basically netting an additional $28,000 on our policy, using loans in 2 different places and still using a 5.5% bank loan to buy a car with.
That's amazing. That's amazing.
And this isn't, I am not recommending anybody do this. What I'm saying is I just kind of started playing with this today, and I started looking at it and I went, what if we did this and this and this? And that could be the same with anything, and that's where I'm using this as an exercise. It doesn't have to be in a stock. If you have something that can produce income, much like any income producing property, you find a gold mine you want to buy. I don't know, anything. You look at that initial $8,000 of interest that we received over 5 years on our policy, on the cash value of our policy, is there forever. It's just going to keep churning away and churning away every year, compounding. And then you find this where we still paid out our interest on our loan, $6,000 over 5 years, but we found a yield that's going to give us 10% a year. So basically we gained another $20,000, plus went off and paid interest, to the bank, but still made that up on our initial investment. It's just crazy stuff.
It is. What's the downside to this, Dave?
Well, the downside is risk. With any the downside is when you take the money out to invest in something that has risk, you are assuming risk.
Yeah.
And that is the downside. And that's where I said, I'm not giving you any advice. I'm just showing you this as an exercise. I was kind of playing with some numbers today and went through this. If you want to sleep well at night and you don't ever want to have any risk, you leave it in there and let it compound. You're still ahead. You're still ahead by $3,000 at the end of 5 years. If you just go out and get a bank loan for your car, you buy the car and just let it sit there. And the whole idea was I'm trying to open this up to all of us as we can do this and this and
Yep.
even this.
Yep.
So
Yep.
Anyway.
Yep. There's so many different ways.
I'm getting better.
Yeah. No, you're
Jody's
great.
looking a little cross-eyed there all of a sudden, but
Yeah.
Anyway,
There's that
right,
smile.
so that was going to be my 5-minute explanation. It took me 25 minutes. Anyway.
Yeah. No, that was great. That was great. It just shows how many different ways you can go. I mean, this is just one example of
And that's
so
why
many.
we wanted to start. And that's why we wanted to start having these Monday night talks, is just to kind of force us to start thinking about stuff.
Yep.
What we can do with it, and it's there.
Nelson always says you got to think differently.
I know.
And that's what this is all about. Jody and Brad have a question. They say, so it's a way to make our money work for us on multiple levels. And
Exactly.
Dave, yeah. Yep.
Exactly. And, we'll get into some other things. I was using a very, I won't say simple example, because the whole idea of real estate investment trust stocks and things is a little bit more complex, but it is. And if you own a business, to be able to use the cash flow that you can use from a policy loan where you otherwise would have to go get a line of credit from the bank it's a tremendous tool for that.
Yep. And you know what? Since you're first in line with your infinite banking policy, there is no credit check. There's a phone call or a simple piece of paper to fill out online. And you're number one. And you're going to get it, whatever the cash value is, up to the max of the cash value. So it's there's never any guessing, and you can always just kind of see what the ledger says. This is how much you have in there, and then just go with it as you need it in your life. The other thing too is, and we keep saying it, we none of us know when our last day is here. And so we don't even take into account the ROI on that from day one. I mean, it could turn into multiples of what you actually have started running through the whole banking policy system. So, yeah. And there's no tax gain, no tax consequence on the gain through your infinite banking policy. Outside of that, it's kind of.
And there will, and I should qualify by saying, if you were to use that strategy on a dividend paying stock, there is a tax on that. I mean, you will pay taxes on any capital gains, short or long term, you have with the money you use from your loan. Having been said, if you look at the returns, what we got talking about last week of how, the difference of just a couple of percentage points is a huge difference in what your actual return rate is Makes a big, big difference.
Oh, yeah. And so Jody and Brad also ask, they go, the money we fund our policy with is completely separate from a loan we pay back to our policy, right?
Absolutely. So your money sits in their cash value growing at the rate that it's growing, at the dividend rate's growing. When you go to borrow from your policy, you're not borrowing your cash value. It's not reducing your cash value. For example, if you have a 401k and you take a loan on your 401k, you take out $10,000, the balance of your 401k goes down by $10,000. This is not the case. What the insurance company does is they look at policy loans as the best risk that they can have in a loan. They take it out of the general pool of the insurance company and they slide you the loan, because that loan is guaranteed by your policy. So if you can't pay it back, nobody gets out of this alive. They're eventually going to get their money back, and they'll get it back basically by taking out of your death benefit at the end. So no, you never reduce you, and that's the magic of this. Is you're basically stacking guaranteed money on top of guaranteed money, and then going out and being able to do things with it while it continues to grow over on the other side.
Yep. Awesome. Well, does anybody have any other follow-up questions? Any questions in general?
Yeah, why is my internet so slow?
Chad, do you have one real quick?
Maybe just a little clarification on loan payback. So at bare minimum, you just have to pay it back once a year. I mean, if you're disciplined,
Correct.
You can do it monthly or really whenever you want.
Right.
And also, if I heard you correctly, bare minimum, we just have to pay the interest back annually.
Correct.
That's it.
Correct. What happens, Chad, is when you take out your first loan, you'll get the money deposited in your account, and you won't hear a thing from the insurance company until the anniversary date of your loan. And about 2 weeks before that, you'll get a letter in the mail that says your loan balance is X, and based on this year's interest that we're charging, your interest payment is X. You can choose to either send us a check, or we can roll it into the loan amount. And there'll be a disclaimer there at the bottom that says, we don't recommend you roll it in. We recommend you paying your interest. What we like to do, and what Paul and I have always coached, is that you set it up, you become your own banker.
Right.
You set it up so you have a amortization table set up, and if you want me to set one up for you, you just call Paul or I, and I'll whip one up on Excel and send it to you, and then you can keep it on your computer to remind you what your payments need to be. We like to overfund the loans back. We like to use a higher than average bank rate, 6-7%. We like to maybe even add in a little, if you can afford $30 here, $40 there, depending on the loan over the course of the month. We like to have that so you get used to paying a certain amount, and before you know it, your loan's paid off early. And then we can go on to the next step, which is either a new policy, or it rolls back into paid up addition riders and grows your cash value even at a greater pace. In the worst case scenario, you're making interest payments and that's it. But we really, we want to talk you through that before you go down that road.
Right.
And Nelson Nash always used the excuse of, if you have a retail store and you're selling groceries and you're stealing cans of peas out the back door, is the same as not paying back your loans. You're hurting yourself on the other end, because all of a sudden your $40,000 loan has a $50,000 balance because you haven't paid anything on it. Now you're just getting behind, and we want to stay ahead of these things. And you treat it like it's the bank. If you were taking the money out from U.S. Bank, you got to pay it back. And so you pay it back to yourselves.
Right.
And it's once you get yourself set up, and like we've always said in this, it's a matter of changing your thinking. It's now you're responsible. Yeah, I'm just going to write a check to myself every month, or to Lafayette or whoever the policy is with, and that becomes your bank, but you're collecting the interest.
Yeah, and I'm just thinking, like minimalist, or worst case scenarios, because I've got teenagers that ask me questions, and my dad, and so let's say you've got cash value of 40 grand, and you take out $10,000 loan, right? And you only pay the interest on it that year. How much can you borrow the next year? Like, how much does that go down?
You can borrow up to the amount of your cash value. So if you got 40,000 the next year, you'll get, what'll happen is you'll get the statement from the insurance company that says your loan balance is $10,000. You owe us $500 in interest.
Right.
Money available to borrow, $29,500, whatever it adds up. If you roll in the interest to your loan, it's whatever the difference is between 40,000 and that amount.
Okay.
What I would share as, in addition to that, is that the next year, you're going to have another deposit. Right. And so with that deposit, depending on which year you're talking about, you're going to have that much more available cash value go into your policy. So the following year, if you paid zero back, you'll have just what you deposited in that ensuing year for available cash value.
Right.
I'm going to show you right now. Can you see this real quick, you guys?
Yeah.
Okay.
Yeah.
So here's your 40,000, and I used the 5-year plan, but you start at 40,000. The next year, if you can see the balance down here, you're going to have 41,629.66 as you're available to borrow, because that you've gotten a $1,629.66 dividend while the year has gone by. Yep. And your interest payment, if it's a $10,000 loan, you owe $500 in interest, but see how that's going to go up as you're going to continue to grow even while you're not, quote unquote, paying the loan back. It's
that's a great point. And you probably don't know yet, because there's a lot of newbies here, but there's a point in the not too distant future where the policy will just pay itself, whether it's paying its annual premium deposit or paying the loan interest going forward in time. It's just the most amazing thing. The deeper you get into this thing, the more it just reveals itself. It's like peeling the onion. It just has so many different applications. And you made the point. The point was, or the question was, well, what if I don't pay that loan back, or to pay anything back on the loan? I just pay the interest, right? Yes, you do. And there's several ways to do that. You could take you could borrow out of your policy to pay for it. You could roll it into your policy loan if you had the available cash value. But just understand this too. If you borrowed, let's say, that $40,000 and you paid back $1 or $100 or $1,000, the amount of interest, that simple interest that's snapshotted over that whole year, is going to be less than if it were the whole amount that you borrowed in the beginning. So it's a constant descending amount that you owe the company on the interest that is due them on the policy, as long as you keep chipping away, like Dave said, just keep paying back. And if you put more money into your loan repayment, that's even reducing the level of interest due at the end of the year even more. So you're playing, you need to really think about being the banker, how right? And what's best for your bank, and how best to manage your money. So, that's why we're here. Dave and I are committed to just having these conversations to help, our clients really understand the power of this.
It does. And it actually helps us to sit down and have to explain it out loud,
Yeah.
there's nothing better than trying to teach something to make you an expert at it, right?
Absolutely.
And this is stuff that floats around in our brains all the time that we sit here and talk back and forth to, but it's like we were on here earlier tonight talking to each other, like, how do we explain this in a simple way? And it's not, I wouldn't say it's simple, but it's to make you, it's just to open up your eyes a little bit to what's there. And then to draw back a little bit on the whole idea of loans is, I started out with what you can do with a loan versus how the loan works. I should have actually started out back there, Chad, a little bit and said, the loan does not reduce your cash value. That's the first foremost thing of an infinite banking policy. And that's why we only use a few specific mutual companies, is because not all companies treat loans that way. We only use the ones that will treat them that way.
Yeah, it just lowers what you're approved for, basically.
Right. Yeah. The last thing you want this to do is act like a 401k loan where it reduces your balance every time you take money out. It defeats the whole purpose of compounding.
Right. I like the fact that you can use some of your cash value money and put towards your annual policy. I think that's really cool.
Yep.
Yep.
Yeah. So, and at some point you're going to do that because you're going to be at the age where you don't want to make payments anymore. And you're going to say, okay, I'm moving into a different phase of my life. Usually it's in retirement years where we sit down and say, okay, what's the plan going forward? As you've been building this up all along. Now all of a sudden your dividends pay your premiums plus throw off even more cash. How are we going to take advantage of this as a way to provide income for you later on in life?
Okay. I've got an oldest son who just got married. So they're young, right? Not a lot of money. They got some college debt, and they just got a house, a starter home. And so I explained a little bit to him. He gets it, but he's like, we just don't really have anything to start with. What advice would you give in a situation like that for some youngsters?
Paul?
Save up and start one.
Save up and start one.
Yeah. They need to save up enough to get it started. And then, once the initial policy is going, you can get set up with smaller policies to begin with. You don't want to, go without food to make sure you're making your policy payments. But on the other hand, you have to have a plan on how this is going to grow to remove other debt in their life as they go on. I mean, to start using the cash value as it grows to become their asset to do this and something else. And you let it, you pay your college debt, you pay your policy premiums. It's to the point where your cash value starts to grow. And at some point you're going to be able to take a policy loan out to pay down your 6% college debt with, like I just showed you just there, where you pay off, you can pay off the loan, and all of a sudden you've reduced your interest rate you're paying out, plus that money still sits there and grows at whatever the dividend rate is. I'll use 4% for the magic number today, but
Okay.
And the trick is, Chad, with younger people, and this is what we like to really stress, is insurance rates on people in their 20s are cheap. I mean, they can get a lot more bang for their buck because they've got the magic of compounding for 30 plus years and lower rates because they're young.
Yep.
Right. Okay.
Cool. Yeah.
Just randomly, I've had two people ask the same question, and they weren't in the same room, and they're like, so, they're like, how does this work if you want your actual money out? Like, say you want to just stop it, which, obviously I'd never do, but they're like, this is your money. And so can you ever just take it out? Right. And I'm like, well, first, I'd never do that. Secondly, I don't know. It's a contract. It's a policy. So I'm not sure.
The answer I would give, Chad, would be they don't understand the
Right.
system, the concept, and I'm willing to bet they really haven't um, had that conversation with Dave or myself or read any books, and
Right.
they're more concerned about, you know, the just some random question, and you can sit
Yes.
there and have those blasted at you all day long, and if you don't understand IBC, you're simply not going to be able to overcome their objections, and you're not in that. I wouldn't recommend anybody have that conversation until they've gone down the rabbit hole, so to speak. Good, bad, and different.
Right.
It's just I would always steer clear of those conversations and say, look, I'll be happy to hook you up with one of the practitioners that I know, and just have that conversation. It's real simple. It's a lot more if you're trying to have that conversation to convince somebody, you're probably going to lose out.
Right.
You know, you just
Yeah.
are. It's like
They
that
were.
in
Yeah.
anything, right?
and
Yeah.
you can find yourself kind of going down the rat hole there with, if there's that attitude that I want my money,
Yep.
and I want it, I want it handed to me in piles of 100s or whatever it is, and I don't want to do this anymore. For some reason, it's stressing me out or something. A, we would try to educate them, but B, there's ways to, people cancel life insurance all the time, but then you lose a lot of money. You lose everything you've gained up to that point, and sometimes it even has a taxable event involved with it, which is
Yep.
why it's not that you're locked into the contract. It's in your best interest as the owner of the policy to keep it going and utilize it from within the policy rather than without. And
Okay. Yeah. Yeah. Absolutely. It
yeah,
was just two flippant questions.
Well, we'll help
So
you overcome that
well,
in the days ahead.
yeah.
or Chad, you could have had the question I got today is, how do I pay for this in Bitcoin?
Ah.
And in the same conversation, it was with a gentleman, and he says, well, what's going to happen when the world monetary system collapses? Do you have an answer for me? I was like, no, I don't have an answer for you.
Right.
Exactly. But
Yeah.
those are the kind of questions that we have to work within the system, and this system works within our system, but kind of separates us from it at the same time. So it allows us to control it.
Thanks, Jody, for making that comment. I appreciate that. She said, Brad tried to explain it to me that, Chad, this bodes well to you, to your questions. And she says, I didn't understand it completely, but I read Paul's book and the light went off. Yes.
Yep.
Awesome. Well, thank you for that. I appreciate that.
All right. It's 50 minutes, Paul. Remember, I said we weren't going to go an hour tonight.
So we beat that by 10 minutes. Guys, we look forward to seeing you next week, and hopefully we won't have any internet issues. And, if there's a topic or something you want to discuss, please email it to us, and we'll be happy to try to include it in the next conversation. Okay?
All right.
Thank you
Thanks
so
for
much.
coming, you guys.